Hi, everybody, and welcome along to the Mint monthly update for the single sector funds. It's just myself, Dave, today presenting about November and how the month performed for the funds and the market. I thought I'd touch on a couple of interesting slides and charts before we delve into the performance of November. And we've been talking a lot in markets and certainly in the media around, I guess, confidence, the recovery and the green shoots in the New Zealand market. But I thought a couple of these different charts below were kind of interesting because we've talked, a lot around how the confidence in the market's been there in terms of retail, consumer, and business. But why we're not actually seeing as much activity as we generally would expect to see. And then the chart on the bottom left there actually shows, it's interesting, it's actually out of the US, but looking at what households are thinking around job security, effectively the probability of loss of jobs. Now, interestingly, when you look at the far right of the chart, you see a big uptick over time in the yellow, which is the sort of low income roles, and that's but the interesting one there as well is the higher end, the high income earners, is certainly ticked up, and that's clearly an impact on what AI might do to people's jobs, and I guess that flows through to job security, and of course that leads into consumption and willingness to do things such as purchasing large expensive assets like houses and other things. So, I guess it's a time while unemployment has ticked up, especially locally, not dramatically yet. It is something that's considered, even people with jobs worried about the outlook and what they might do, and sort of tied into it in a way is the other chart on the right there, which is looking at the age of first home buyers. And this is a Westpac chart they put out recently, and again, it's quite surprising to see that the age of the average first home buyer in Auckland has now hit 37 years. So when we also talk about the lower interest rate environment and the benefits coming through, I guess as that first home buyer age ticks up, the cohort that benefit from lower rates does tend to shrink. So it is interesting. So one reason why some of the positivity is yet to come through in a couple of different areas. Now, rolling through to the month of November, and it was a reasonably flat month for the market. We did sort of see a bit of reversal of some of the other months' trends, which was property backwards a little bit. And while we did see the OCR cut over the period, what we did see was effectively an announcement that we will no longer be seeing any more cuts, or that's the interpretation from the market. But again, the chart on the right sort of showing what made the month up, and it was a bit of a mix all round. Names like Infratil just sort of drifted off on a bit of AI fear around their CDC data centers. Names like Meridian are a little bit soft, and I'll touch on the Gentiles in a second. But also, we did see the REITs, after having quite a reasonably strong year, fall in November on the back of the no more cuts vibe from the sector. And then we had a few bounce back, which was a bit of Somerset and Mainfreight, which had been soft leading into this month, starting to recover and partly on results. We did have a reporting period in November. It's usually a sort of quieter one overall, but a few key names there, and Mainfreight was one of those. I went out and saw Don and the team in Mainfreight, and while it's been a tough year for them, certainly has in this part of the world, in New Zealand, we did see some potential improvement, and I guess we're sort of, are we through the worst of it is the view, and share price did react accordingly, and clearly for them, while some of their offshore businesses in the US in particular are struggling, Australia has been a strong place, both in their warehousing business as well as transport. So they are winning some market share and continuing to see some improvement. And Q2 on Q1 has certainly come a lot better than the rather bleak AGM update we did see after Q1. So that is, positive signs. And again, with people wanting to get exposure to cyclical recoveries, Mainfreight has certainly benefited in the month for that. Somerset was more of a bounce back from a weaker period. Obviously, we had their update a while ago, so it was more just a positive view on house price and bouncing off its recent lows. Tower was another name that had a solid result and continues to perform well in the fund. They surprised with an upgrade in their dividend for the full year, which was probably a tad fraction better ahead of what some people had expected. And also they helped to reiterate their outlook in terms of GWP growth, which is looking positive in the next few years as they onboard the partnership with Westpac and also their Kiwi bank. So again, a couple of positive stories there. And in the Gentailer sector, we did see updates across the three of the four large names. Both Genesis, Meridian, and Contact provided investor days all within a short time. In general, it was all positive in terms of after a few of the government reviews sort of showing that the sector is operating as roughly it should. We did get an update from a lot of them around their pipeline of development. as well as the CapEx spend that came with that. Meridian was off a little bit. I guess the take from the day was, while they are looking to progress with some large scale developments in terms of the core stay in business CapEx, in terms of refresh around the Waitaki system and a few others, probably looking a little bit higher than someone expected in the medium term, but obviously will revert out over time. But have also benefited more recently from a bit more rain and snow in the South Island. So yeah, reasonably muted there. Contact was a rather bullish update. We saw some strong updates around their pipeline. Even on the day of the Investor Day, we did see them receive consent for a large amounts of batteries at Glenbrook, which is a positive for the business as they look to move a bit more generation north. We also saw a positive update post the Manawa transaction, and that continues to perform well. There was some skepticism initially around what they paid for that deal, but it's proving to be what looks like a good outcome, especially as the hedge that Manawa had with Mercury rolls off. That should look to benefit Contact in terms of how they flex and manage their portfolio. And then Genesis as well talked up a lot of projects and their outlook and how they will use their assets as they develop renewable assets on top of the, I guess, the flexibility they want to use in their thermal fleet. Again, balance sheet's looking a little bit stretched, and reading between the lines, it does feel like they might be looking to raise capital over the medium term. We will see. Obviously, the government and their recent updates has said they're likely to support, under certain conditions, capital raise environment. Yeah, so reasonably strong outperformance for the month for the fund, and it's looking reasonably good into the new year for a lot of the sectors. The Australasian Fund, again, reasonably solid month there with support from Mainfreight as well as Somerset, similar to the SRI Fund. We did see a positive update from Amcor for their Q1, continuing with their strong cost out, and effectively, while earnings aren't taking off to the races, they're not looking too bad from here. So we saw a little recovery there. Few names that are being left behind in Xero and some of the tech names in Aussie. We did see stronger than expected inflation numbers in Australia, which effectively saw a bit more hawkish tone, and with higher interest rate environment expected, we did see a few sectors in Aussie sell off, including REITs, but also some of the long dated value names such as, or growth names such as Xero did sell off a little bit, as well as a bit of AI fear. And also they have the Emilio transaction, which, while they're embedding, looks like it's going okay. There's still some skepticism around that, but a name that we think provides a good medium-term outlook and valuation. The chart on the right there is the Aussie earnings outlook that for the next couple of years, the sort of light blue and the yellow. And we did see an AGM update that was generally positive across a lot of the Aussie names. Resources certainly helped, and commodity prices have helped in certain areas there, especially gold. But again, the general view is that, it was more earnings positive than earnings negative around outlook within Australia. Across the two funds, both the SRI and the Australasian Fund, we did participate in the Vital capital raise, which has been a new addition to the funds. Additionally, the AET fund has trimmed out its Charter Hall REIT position as well, which has performed particularly well. Charter Hall, I can touch on a bit more in the property fund shortly, had a particularly strong month. And so that's a name that was removed from the fund throughout the period. Touching on the Aussie property sector, Australasian property sector, sorry, that is, a reasonably weak month overall. Both New Zealand index down 3.2% and Aussie down even more, and 3.8%. Again, this was around the hawkish tone from both central banks, really around the fact that we shouldn't expect any more cuts and likely to see hikes. Again, in terms of tone for the market, the REIT sector in New Zealand has performed well. It has had a good year and probably outperformed the overall NZX 50. And so when you look at it relative to a few other sectors, I thought I'd put this chart in here. The spread between the electricity and other bond proxies versus the REIT sector. On the right-hand tail, as that gap's closed, it's shown that, there's not the same spread and excitement from here than we've seen, but, we'll look ahead and it should be somewhat supportive as, I guess, the interest rate costs flow through to the sector, and cap rates are relatively firmed from here. So we should be positive, but, as saying, there's been some good wins for the sector already. As it touched on, Charter Hall certainly had a strong update with the Aussie market down 4 and it up 11. It certainly outperformed. We did see an AGM update in terms of earnings upgrade, partly to do with strong fund flows in their key funds, as well as preference for their capital light model, which has continued to support. Yeah, Vital, as we said, was a positive contributor to the fund, largely because we were underweight going to the capital raise. but took on some stock from it. So that was a great opportunity, we thought. And the internalisation of management was something we'd been long looking for within that business, so a positive outcome. And similarly, we trimmed out a fair bit of our Charter Hall position on the back of its strength as well. And another name we've been keeping a close eye on is Goodman Group. It's been under the pump a little bit, largely from the AI thematic, which has weighed on quite a few different sectors in terms of the bubble. Certainly a lot of views out there, but we still believe Goodman Group is an overall REIT in this industrial space, as well as the potential for some data center development is reasonably well positioned. We continue to support their name. So thanks everyone for dialing in and listening. And again, thank you for your support throughout the year. Wishing everyone a happy holiday over the break. Hope you get to enjoy some of the summer sun. And again, look forward to touching base in the new year. But as always, if you have any questions, want to get in touch, info@mintasset.co.nz.